Have you ever dreamed of just leaving the 9 to 5 grind, like years ahead of schedule? Well, there's this really powerful trend shaking up how people think about retirement, and it is all about generating income. So today, we're going to dive deep into the world of high-yield dividend ETFs and see how a huge wave of investors are using them to chase that exact dream. Okay, let's get into it.
I mean, this is the big question, right? Can you actually pull it off? The whole idea is to build a portfolio that kicks off enough cash every month to cover all your living expenses. You're basically creating your own paycheck without ever having to sell off your investments.
And believe me, this is not some fringe strategy we're talking about. Since 2022, a jaw-dropping $160 billion has poured into ETFs that offer yields of 8% or more. To put that into perspective, the assets in these funds have quadrupled in just the last 3 years. That is not a trickle, my friends. That is a flood. It's a huge shift in how people are investing.
And this right here, this is the core promise that's getting so many people excited. You know, the old school path was you had to save up millions just to live off a tiny 2 or 3% yield from some blue chip stocks. This high yield approach, it suggests a totally different path, one where a smaller nest egg, if you invest it strategically, can generate the income you need to retire way, way sooner.
So you gotta ask, why is this happening right now and on such a massive scale? We're calling it the high-yield retirement rush. Part of it is the economy, for sure. Interest rates have been higher than we've seen in years, so the demand for reliable income is just through the roof. But it's also a real shift in mindset, especially with younger investors who are prioritizing cash flow today over some uncertain growth way off in the future.
And the data totally backs this up. Just to give you a clear picture, in a recent period, for every $6 that went into an ETF, one of those dollars was funneled directly into a fund built specifically for high yield. That just shows you how mainstream this whole strategy has become. It's a clear signal that the goal isn't just about growing wealth for later, it's about creating income you can actually use right now.
Okay, so your interest is piqued. I get it. But with literally hundreds of these funds out there, how in the world do you separate the good ones from the duds? Let's walk through a super simple but really effective checklist you can use to evaluate these ETFs for yourself. So here it is, the 4 big things you're looking for. A solid high-yield ETF for retirement income should check these 4 boxes. First, pretty obvious, a high dividend yield. Second, monthly payouts, we want it to feel like a paycheck. Third, a consistent dividend history. And fourth, you gotta have strong diversification to keep that risk down. Let's just double-click on that second point for a second. Why are monthly payments so important? Well, because retirement is all about cash flow, right? Your rent or mortgage, your car payment, groceries, they all come at you every single month. So getting a dividend deposit every month makes managing your finances in retirement feel just like getting a regular paycheck. It is so much more straightforward. Now, listen up, because of all the points on that checklist, this one is arguably the most important: the dividend history. A fund that's kept its payout steady or even grown it over time, that shows stability. But, and this is a big but, if you see a trend of the dividend consistently going down, that is a major red flag. It could be what's called a yield trap, where a juicy-looking yield is just hiding a failing strategy. You gotta watch out for that.
All right, we've got our checklist. Let's put it to use and explore some real-world examples. We're going to take a quick tour of a few key ETFs, and you'll see how each one uses a totally different strategy to generate that high income we're chasing.
Okay, before we jump in, we have to talk about something called preferred stocks. Just think of them as a hybrid. They trade on the market like a regular stock, but they have a special perk. They get paid their dividends like a bond. That means if a company is paying out dividends, the preferred shareholders have to get their money before the common stockholders do. It just adds a nice little layer of safety.
And that brings us to our first fund, PFFA. This ETF invests in a whole pool of those preferred stocks we just talked about. Now, to juice its income, it uses leverage, which basically means it borrows money. That definitely adds risk, you need to know that, but it also helps boost its high monthly dividend. It's a really interesting play, especially because preferred stocks could do very well when interest rates eventually start to fall.
Next up, let's talk about a strategy that has gotten incredibly popular: the covered call. Here's how it works in simple terms. A fund owns a big pile of stocks. Then it sells someone the option to buy those stocks from them at a higher price later on. Just for selling that option, the fund collects a fee, which is called a premium. And that premium gets passed directly onto you as income. Now, what's the catch? Well, you get all that income today, but you give up some of the massive upside if those stocks just go to the moon.
And a perfect example of this is the ETF SPY. It runs that covered call strategy on the entire S&P 500. A lot of people call it the gold standard in this space because it has consistently kicked off a yield of over 12%. And you guessed it, it pays out that income every single month.
Now, this is where it gets really interesting because it shows you just how much the specific strategy matters. So here you've got two different funds, QQII and GPIQ. They both run a covered call strategy on the exact same index, the NASDAQ 100. But they have different goals. QQII is built to squeeze out the highest possible dividend yield. Meanwhile, GPIQ is trying to get you better growth in the fund's actual share price. It's that classic trade-off, more income today or more growth for tomorrow.
And this leads to such a great point. People ask, well, if I own both of those, isn't that redundant? And the answer is no, because true diversification isn't just about owning different stocks. It's also about owning different strategies. One might do better when the market is soaring, the other might do better when it's flat. So diversifying your strategies, that's a real pro-level move.
Okay, now let's look at another huge one, JEPI. It uses a pretty unique structure that involves something called equity-linked notes. All you really need to know is that this structure makes it a more conservative, less volatile investment. The trade-off? You don't get as much growth potential, but a chunk of its dividends can actually be more tax efficient, which is a nice little bonus.
And finally, we've got QDVO. Now, unlike the other funds that just track an index, this one is actively managed. The managers are actually hand-picking between 20 and 40 growth stocks they really believe in, and then they run a tactical covered call strategy on just those names. So yeah, it's less diversified by design, but the whole idea is that you're betting on their stock-picking skills to deliver the goods. Okay, so after that whirlwind tour, what's the big takeaway here? Let's try to boil all of this down into a final word for you, the investor, to really chew on.
Here are the most important things to remember. Number 1, this high-yield trend is the real deal. It's backed by serious money. 2, always use that 4-point checklist we talked about: yield, monthly pay, dividend history, and diversification to guide your decisions. 3, understand that the strategy behind an ETF matters just as much as the stocks inside it, and every single one has its own risks. And 4, the most important point of all, this is just a starting point. You must always do your own research to see if these tools are a good fit for you.
And that really leaves us with one final question for you to think about. Look, these funds, they offer a really compelling alternative to the old way of retirement planning. But they absolutely come with their own unique risks and trade-offs, whether that's capped growth or the risk that comes with leverage. So the ultimate question isn't just, do these things work? It's, is a high-yield income strategy the right tool to help you build your financial future?